In our last episode, we took a deep dive into the burst of Japan's modern economic bubble. But here's a twist: economic bubbles are pretty much par for the course in rapidly growing economies. Yep, all the top players on the world stage have had their share of asset bubbles. Now, if a country plays its cards right, a burst bubble doesn't have to be a disaster. Take the dot-com bubble burst in 2000, the US took a tumble, sure, but it wasn't long before it was back on its feet, ready to inflate the next big bubble. So, this begs the question, why did the burst of Japan's economic bubble hit them so hard? Why did they fall and seemingly decide to just stay down? This is the most intriguing and puzzling aspect of Japan's economy. If we look at the trend of Japan's GDP, the 30 years following 1991 were like a roller coaster ride, with a steep plunge just as it seemed to climb. So, how exactly did Japan lose 3 decades? In today's episode, we're diving into the lost 3 decades of Japan. What caused this prolonged period of economic stagnation? Was it just the aftermath of the bubble burst, or were there deeper issues at play? Welcome to Economy Quest. If you are interested in learning about the economy of Asia, hit that subscribe button, ring the bell for notifications, and embark on this journey with Economy Quest. In 1991, when Japan's capital bubble burst, the central bank and government took some pretty drastic steps. They slashed interest rates to an all-time low of 0.5% and racked up a mountain of foreign debt to boost domestic demand. And sure, it seemed to work, for a bit. But underneath the surface prosperity, there was a ticking time bomb. You see, the economic bubble of the 80s, on the surface, seemed to be fueled by the Bank of Japan's rate cuts. But those cuts weren't the only culprits. The conglomerates, Japan's financial powerhouses, were egging it on, adding fuel to the fire. As Japan's financial markets began opening up, and with interest rates hitting rock bottom, the giants of Japanese industry shifted gears. They moved from traditional bank loans to raising funds through public bond issuances. For the banks, this shift was a double whammy. Not only were profits already slim due to low interest rates, but now their loan business began to dwindle. In a bid to stay afloat, banks lowered the bar for lending and eased up on their scrutiny. It was a move that echoed the prelude to the 2008 U.S. subprime mortgage crisis, channeling funds to individuals and businesses with shaky credit and even shakier ability to repay. Once these individuals and companies got their hands on the money, they plunged into the real estate and stock markets, leading to an era of excessive lending and credit expansion. The bubble just kept getting bigger. When the bubble finally burst, the borrowed money couldn't be repaid, and the properties used as collateral plummeted in value, leaving banks with a mountain of bad debts they couldn't recover. This scenario might sound familiar, as it closely mirrors the U.S. subprime mortgage crisis, which, despite its severity, the U.S. managed to recover from after a few years. However, Japan's real misstep lay in its economic policy known as the convoy system, which protected poorly performing companies from the natural competition of the market. Instead of allowing these companies to fail, the government would step in with heavy-handed interventions to keep them afloat. This approach only deepened the problem of non-performing assets, making the economy appear healthy on the surface while it stagnated underneath. In 1997, this ticking time bomb finally exploded. Nissan Life Insurance declared bankruptcy, marking the first financial company failure in Japan since World War II. This set off a domino effect, leading to a stock market crash and igniting the full-blown Asian financial crisis. And so, Japan lost its first decade in a haze of economic uncertainty and misguided policy interventions. It wasn't until after 1997 that Japan began allowing financial institutions and businesses to fail, tackling the issue of bad debts on a grand scale. At the same time, the devastated Japanese banks tightened their credit services across the board. This meant less money circulating in the market, leading to decreased demand and falling prices. A drop in prices meant companies earned less, leading to reduced profits. This, in turn, forced companies to cut salaries and lay off employees, causing unemployment rates to rise. This triggered a vicious cycle: less money in people's pockets led to even lower demand. And so, Japan fell into the dark hole of deflation. In response to deflation, the Bank of Japan took rates down to 0% in 1999 and initiated a policy of quantitative easing in 2001, aiming to stimulate the economy and consumption. Quantitative easing, or QE for short, is essentially like printing money, but indirectly. The central bank prints a vast amount of money to buy government bonds and other long-term securities from various financial institutions. This is akin to stuffing cash directly into banks' hands, providing the market with ample liquidity. On the government side, it continued to borrow, increasing the ratio of national debt to GDP from 130% to 180%. With such a potent combination of strategies, plus nearly a decade spent cleaning up the bank's bad assets, Japan was just about to get back on its feet. But then, the 2008 U.S. subprime mortgage crisis hit, sending shockwaves around the globe. Followed by the 2011 Fukushima nuclear disaster, Japan faced setbacks yet again, throwing it back to square one.
The 2011 Fukushima nuclear disaster in Japan was the second worst nuclear accident in history after Chernobyl.
And so, after a decade of efforts, it felt like we ended up right where we started, back at the beginning of another challenging decade. In 2012, Shinzo Abe was re-elected as Prime Minister of Japan and appointed Haruhiko Kuroda as the Governor of the Bank of Japan. Together, they embarked on what is arguably the most aggressive stimulus policy in human history, known to us as Abenomics. Abenomics is built on three arrows: aggressive monetary policy, flexible fiscal policy, and structural reforms. The fiscal policy arrow had mixed results. The reform arrow made a lot of noise but had little impact. However, the monetary policy arrow was nothing short of revolutionary. Not only did it introduce negative interest rates, but it also launched an enhanced version of quantitative easing, dubbed QQE, qualitative and quantitative easing, which continued the spree of money printing. The yen's value plummeted, sparking a long-awaited bull market. Yet, the real economy lagged behind expectations. GDP growth remained sluggish, and efforts to stimulate consumption and demand fell short, with inflation rates stubbornly refusing to rise. So, you might wonder, with the Japanese government and the central bank pulling out all the stops, invoking every monetary and fiscal policy in the book, and then some, to stimulate the economy and drag Japan out of the deflationary spiral, why aren't we seeing the desired results? The primary reason boils down to Japan's continuous population decline and severe aging issue. Take a look at this graph of Japan's population numbers and growth rates. Since 2010, Japan has seen a consistent negative growth in its population for over a decade. Now, fast forward to the population pyramid in 2023, where those aged 65 and above make up 26% of the population. Projecting to 2040, this demographic is expected to reach 31%. Meanwhile, the base of the pyramid, representing the new and young population, is increasingly taking on an inverted triangle shape. This demographic shift is a critical factor stymieing Japan's economic revitalization efforts, underscoring the complex interplay between population dynamics and economic health. This is indeed alarming. Remember, the population is the driving force behind economic growth. Without people, there's no demand, no consumption, no growth. And the elderly, typically, don't have the same spending needs. Even if you were to put money directly into their hands, they're more likely to save it in banks, invest in real estate, or buy stocks, rather than spend it in the real economy. Thus, the money ends up back in the capital markets. With overall demand remaining weak, Japanese companies, flush with cash, lack the incentive to expand production, engage in marketing, or pursue investment and acquisitions. Instead, they too turn to buying land or stocks. This results in a scenario where the government and the central bank are aggressively printing money and stimulating the economy, but without visible improvement in the real economy. Instead, the stock and bond markets appear to be the only beneficiaries. In 2022, the outbreak of the Russia-Ukraine conflict led to a global energy crisis.
We're at a moment in history now where energy has become a weapon.
Under the pressure of global inflation, Japan finally began to feel the long-absent inflationary pressures. With the price index rising for 20 consecutive months and corporate capital expenditure growing, many companies started to increase wages. Japan seemed to be witnessing the dawn of a new era, hopeful to emerge from 3 decades of deflation. The recent signs of inflation and wage increases could signify a turning point for Japan's economy, potentially marking the end of the deflationary era. However, for this growth to be sustainable, Japan will need to tackle the root causes of its economic stagnation. This includes addressing the aging population, encouraging workforce participation among all demographics, and fostering innovation and productivity in its industries. As we watch Japan navigate these challenges, it's clear that the path forward is not just about monetary and fiscal stimulus but also about structural reforms that can support long-term growth. Only time will tell if this uptick is the beginning of sustained economic revival or just a temporary surge before the next challenge.